In today's video, I'm going to be talking about the difference between YMAX and WPAY. On the surface, these two ETFs that pay weekly dividends seem very similar, but when you look a bit further, they actually have some very important differences in how they're structured. So my hope is by the end of this video, you'll have a better idea of which one is suited for you, or you might even find out that neither tickles your fancy. YMAX holds a collection of YieldMax single stock options income ETFs. These include ETFs like TSLY, CONY, NVDY, and the popular one, MSTY or MISTY. All these single stock ETFs hold synthetic positions on the security and then write options on them to generate income. And later in the video, we'll talk about what a synthetic position is, but basically all you need to know now is they don't actually hold the underlying stock. So NVDY doesn't actually own NVIDIA. It owns options that mimic owning NVIDIA and then writes options on that to generate income. WPAY is an ETF from RoundHill Investments. And similar to YMAX, it holds a basket of single stock ETFs. But those ETFs, like APLW or TSLW, don't use options. Instead, they use something called total return swaps. And if you've never heard of a total return swap before, don't worry, neither had I before looking into this fund. So a total return swap is just a contract between RoundHill and a counterparty. Let's use APLW, the Apple Weekly Pay, as an example. For a fee that RoundHill will pay, they will get the total return of Apple for 1 week. So let's say that Apple starts at $100 on Monday, and at the end of the week, Apple is $105. In that week, Apple's return was $5 or 5%. So RoundHill will get $5 from that counterparty. Now, the interesting thing about RoundHill is that they use leverage, and their aim for leverage is 120% of the total return in 1 week. So in that example where Apple returned $5, RoundHill would actually get back $6. Now, why would the counterparty agree to do that swap with RoundHill? It's because RoundHill is swapping a financing rate with the counterparty. Now, we don't actually know what that rate is, but in some cases it might be LIBOR, which is the standard bank-to-bank lending rate, plus an additional 2 or 3%. This seems like it would be an especially great idea in a bull market. So when Apple goes up 10%, RoundHill's APLW would go up 12%. But in a down market for Apple, the returns would go down even more. So how does RoundHill create these distribution? Now, in that swap, what actually happens is RoundHill gets that cash. So if Apple did go from $100 to $105, the counterparty would pay RoundHill that $5, but the leverage would mean RoundHill would actually receive $6, and they would then distribute that back as cash to the shareholders. Now, how does RoundHill actually determine that? Well, here's the writing straight from their prospectus. The amount of each week's distribution is based on a formula that incorporates a number of dynamic market inputs, including the total return of Apple shares and the implied volatility of Apple shares. Now let's pivot back to YieldMax's version of the Apple ETF, which is called APLY, and let's see how they make their income. So here are the underlying holdings of AAPY, which is the YieldMax Apple Income ETF. And remember, it doesn't actually hold Apple. Instead, it holds a synthetic position, which I've highlighted in green. So you can see that it has a put here at the top. The P is for put, and they've sold that put, the right to sell Apple, at $205 here on or before October 17th, 2025. Now that will capture the downside of Apple. The upside of Apple is going to be captured by this call here, which is also at $205. So they have the right to buy Apple at $205 on or before 10/17/2025. So they're getting the downside and the upside of Apple with this synthetic long position created with a put and a call. Now, how do they generate the income? Well, that's highlighted in yellow here. And you'll see that these are all calls that they've sold. They're not covered calls because a covered call, you have to actually own the stock. They're just calls by themselves. But you can see that they've sold some calls and bought some as well. The sells are negative, the buys are positive. So you can see the total here for the calls is $852,000 that they've sold and they've also bought about $53,000 for a net premium received of $798,000. Now, what they're doing here, if you look at the prices, is you say covered call at $235. So they sell it. They can sell Apple at $235. They can sell it at $237, and they can also sell it at $240. Then they bought them at $242 and $245, so that if Apple does go way past those prices, if it goes to like $250, they can also capture some of the upside of Apple by buying it at $242 or $245. So that's the makeup, the composition of AAPY, which is the YieldMax fund. And if you wanted to see the composition of APLW, it's right here. This right here is the swap. You can see this 03 is March, this 19 is the 19th, and that 26 is the 26th. So this contract is in place until March 19th, 2026. And then that leverage that I talked about before, that 120%, is coming from the fact that they also hold Apple as well. And you can see that this adds up to 120%, which gets them their leverage to be 120% exposed to the price of Apple. And as for just a direct comparison of fund to fund, let's go over some of the basic differences and similarities. So the yield is about the same, 53% to 52%. It does change weekly depending on the total return, because WPAY is all the underlying holdings and their total return makes up the distribution. As for YMAX, it's how much volatility is in the underlying holdings, which generates the option income that makes up the distribution. They both pay weekly. The AUM, so only $57 million for WPAY. YMAX has $1 billion. YMAX started at the beginning of last year in January, and WPAY is very new, starting in September. The number of holdings. So WPAY basically has the suite of RoundHill leveraged ETF income products. So I have that here. WPAY has about 15. They have ones on Apple, AMD, Amazon. They do have Broadcom, which is not something that YMAX has. So YMAX does not have a Broadcom options income ETF. WPAY also has Google, Robinhood, Meta, Facebook, Microsoft, the usual suspects. YMAX has a lot more. It has these same ones here as WPAY. It also has Airbnb options income ETFs, Snowflake, PayPal, a Bitcoin one, a gold miners one that tracks the ARK Innovation Fund. So they've got a lot more. And the numbers there are 15 holdings for WPAY, 31 for YMAX. Now the management fee. RoundHill actually waived their management fee. WPAY management fee waived to 0% until at least September 30th, 2020. So 0% management fee, but they still have a fund fee and expense fee. YMAX does have a 0.29% management fee and the same exact fund and expense fee. So the total fee you'd be paying if you owned YMAX would be 1.28%. For WPAY, it would be almost 1%. Now, the cash balances are fairly similar, and those will probably change and fluctuate week to week. But I did want to point that out as well, that YMAX has a little bit more cash. Now, I went to the RoundHill website to look more into these levered income ETFs. And here's a nice comparison I found on these. So they're saying you have 4 options when it comes to just owning stock. You've got single stock, which would be like just owning Tesla. A covered call one, which would be like TSLY from YieldMax, or you could have a leveraged Tesla position, which would be like TQQQ, or you could use RoundHill Weekly Pay. And so they did this nice table here, which was comparing the upside potential. So for a single stock, of course, it's unlimited and you get all the gains. A covered call ETF, it would be capped at the strike price. Leveraged, it would be unlimited plus the multiplier of the gains. And then for weekly pay, again, unlimited and 120% exposure of the weekly moves. For the income and distribution, for a single stock, it's going to depend on the dividend. For covered call, you get the options premium. For leveraged, you typically don't get a yield there. For weekly pay, which is what RoundHill is doing, you get the leveraged weekly stock exposure. So again, that's if Apple goes from 100 to 105, they want to pay out that distribution. So volatility, it's going to be whatever the stock is. Covered call ones are supposed to be less volatile because you get the premiums, so that cushion the downside. Obviously, the leveraged ones are going to have much more volatility, and so will weekly pay. We'll explore that when we look at the charts. Your total return from the single stock is just going to be whatever the single stock return is. For the covered call, it's going to underperform in up markets because that upside's capped, and outperform in down markets, hopefully, because that downside is also limited. Leveraged ones, again, outperform in up markets, underperform in down markets. For weekly pay, outperform in up markets, underperform in down markets. We'll see that in the charts there, but it's basically if it goes up 120%, basically if the stock goes up 100%, weekly pays go up 120. If the stock goes down 80%, weekly pays could go down 100%. So this is the interesting part, the use case. They're saying that if you're growth-oriented and long-term, single stock is probably best. If you're focused on income and you have a market-neutral stance, then covered call. Leveraged is really for traders to get benefit of short-term moves. And then they're saying weekly pay, they focus on income for bullish single stock favor. So what does this all look like in terms of charts and how these compare? So at the top here, I've got AAPW, which is RoundHill. I've got Apple itself, which is just, the stock, and APLY, which is from YieldMax. And I've adjusted this for dividends so that we can see the total return. And what we can see here is in that the 3 months, the RoundHill ETF performed best on a total return basis, 27%. YieldMax performed the worst at 17%, and Apple came in the middle. Now, if you don't adjust for dividends, what you see is that Apple had the biggest moves. So if you were totally concerned about the actual NAV and the price moving up, then Apple would be the one to get. But if you wanted those dividends, then AAPW would probably have been best there. Now, if we look at just a 1 week thing, a 1 week chart, kind of what we expect because AAPW is supposed to be doing 120% of the Apple movements there. APLY is not levered up, but you do get the weekly income. So if we don't adjust, here's what it looks like there. Good moves in Apple meant good moves in both of these. Now, if we look at all time, this is where it gets interesting because AAPW is actually down 20% if you don't adjust for dividends. APLY is also down 20% and Apple is pretty much flat. Now, if we do adjust for dividends, Apple is up, the other two are down. And you see AAPW is down the most, even over the lifetime of the fund. Now, the reason for this is that it's been a fairly neutral market for Apple, where they've had a few up weeks and had a few down weeks. So RoundHill hasn't benefited from that 120% exposure. Now, if we look at another RoundHill ETF like PLTW, and let's remove the other indicators there, PLTW, which is the Palantir weekly pay, and we look at the YieldMax one, PLTY, and we also layer in Palantir by itself, stock, and we do all-time, which will show us the beginning of PLTW, we see that it is actually up 68% when you adjust for dividends. Palantir up 62%, and PLTY about half of that at 33%. Now, what happens when you don't adjust for dividends? Palantir is up the highest, has the most NAV movement, PLTW 13%, and PLTY down minus 25%. Now let's adjust for dividends because that's what matters here. These are weekly pairs. And then let's go to let's do a 3-month chart, and we see PLTW is up. PLTR, Palantir, is also up. And the reason for that is that Palantir has just been ripping. If we look at Palantir by itself, where'd it go? In the 1 year chart, up almost 400%. Year to date, up 142%. Now let's look at PLTW. Year to date, up 13% there just on NAV alone. So what we're seeing is that these weekly pays that don't have capped upsides from the options trading are actually doing pretty well because they've got those total return swaps. So I want to end the video by going back to this table here that RoundHill provided. It is very interesting and it does kind of put some perspective on it. It kind of tells you, all right, you look at the use case first and decide why you would want to invest, and then go further into which one of these makes the most sense for you and which are you most comfortable with. We're going to be doing more videos on these weekly pay ETFs from RoundHill. I think they're very interesting. I haven't invested in any yet, but as I do more research, I'll let you guys know if I do end up investing. So thanks for watching the video. I know we ran a bit long, but hopefully it was packed full of information, and I'll see you in another video.